Hello and welcome to Business Line. Hundreds of billions wiped off the world's financial markets at the beginning of the week as Chinese rout sent shares tumbling in Europe, Asia and the US. This plunge was dubbed Black Monday as China's stock markets have given up all the gains made over the year. The aftershocks were felt in the whole world, with traders in panic calling it the worst day in many years. Commodities like crude oil tumbled to multi-year lows. Currencies of emerging markets weakened as investors dropped the assets, having taken fright. Well, the country's stock market has been falling over a few weeks, but what did trigger the great fall of China?
In China, markets didn't just stumble overnight on Monday, they tumbled. The Shanghai Composite Index finished trading 8.5% lower, the largest one-day percentage fall in over 8 years. And, but for the suspension of some major company stocks, it could have been worse. And this is no one-day wonder. Equities have been sliding at an alarming rate since June. Growth of 7% in the first quarter of this year may sound impressive in European terms, but the fact is that the world's second largest economy is slowing down. Manufacturing output's down and exports have been slipping back. Factories have been slashing prices and laying off workers. At 7.4%, 2014 saw the lowest growth in China for a quarter of a century, and analysts say it doesn't look like picking up anytime soon. The government and central bank have been attempting to manage the situation, pumping money into the markets and devaluing the yuan, but so far it hasn't worked.
In the bigger picture is not only the equity market that is commanding the concerns. The recent push to make the currency more marketized by shifting the currency policy framework. They're dealing with the aftermath of that as well, because capital outflows are likely to be higher in July as a result.
The markets are anxiously waiting to see what the government will do next. Some think they'll reduce interest rates. Others think Beijing may wait and see where the market takes things. All seem to agree there's more uncertainty ahead.
Shares in China had soared 150% in the 12 months to mid-June, as individual investors piled into a rising market, often borrowing heavily to do so. This and the recent data are considered by many as signs of a major economic slowdown. To understand why the world's second biggest economic engine has been losing steam, let's first see how it had gained it. China's economy was overheated in 2007, with the GDP growing by more than 14%. The global economic slowdown, which began in 2008, impacted the Chinese economy, particularly its exports, cooling down the pace of the economic growth to 9.6% and 9.2% a year later. In response, the Chinese government implemented a large stimulus package, providing a sustained recovery in 2010, when the real annual GDP growth rate rose to above 10%. Since then, the pace has been a bit slower, but the economy has been growing. At the end of 2014, Beijing reaffirmed its commitment to a new normal of slower but more sustainable economic growth. First of all, it means shifting the focus from exports to domestic consumption and services. The Chinese authorities have been sticking to their guns and saying that they remain on track to meet their forecast of 7% GDP growth for 2015. The International Monetary Fund and the Organization for Economic Cooperation and Development have updated their forecasts respectively to just under 7%. The World Bank is being slightly more optimistic. So you could say that the current slowdown is not a surprise. Moreover, Beijing warned it is a deliberate policy shift. So what's all this stocks fuss about? Markets take fright that the transition to a new economic model might be disruptive. And in case with China, disruptive means disruptive everywhere. Following an 8.5% decline on the Shanghai Composite Index, the oil prices plunged to multi-year lows and concerns about a slowdown in Chinese demand, the world's second largest oil consumer.
Crude oil prices fell below $45 a barrel on Monday, the lowest level in over 6 years. Analysts say the price reflects a slowing down in demand from China, just as production in Iran and the US threaten a global glut. Brent oil fell as much as 6.5%, extending a 7.3% drop last week that was the biggest in 5 months. Commodities sank to the lowest level in 16 years on forecasts for the weakest Chinese growth since 1990, sending investors to seek out safer assets.
the Chinese crisis has had wider consequences. Unexpectedly for many, the euro surged against its peers on Monday after staying just cents away from parity with the US dollar. Suddenly, the single currency was one of a few rallying assets in the world on Monday. A new safe haven causes problems for the European Central Bank and its efforts to jumpstart the economy. A stronger exchange rate has the potential to curb exports and slow inflation, as Beijing knows very well. Global stocks have had hard days because of the Chinese crisis, especially the most exposed. Well, they say heaven helps those who help themselves. And while some panicked, others were taking action. This is it. This is IT.
When there's a big storm, all you can do is hope your captain knows what he's doing. Just ask Apple shareholders. The company started the week trading down more than 10%, with stocks opening below $100 for the first time since October. Later, they miraculously went back into positive territory, finally ending the day down only 2.5%. An acceptable loss on the so-called Black Monday, with Cupertino regaining more than $64 billion in market cap. What happened? Well, Tim Cook happened. All it took was an email sent to Mad Money TV host Jim Cramer. In the message, Apple's CEO appeases concerns by underlining solid results in China, notably in terms of iPhone activations and App Store performance. Now, experts say Cook's unconventional move may have infringed disclosure rules. Public companies must share information with all investors at the same time, but in this case, we don't know whether the email was made public immediately. In any case, investors in big tech stocks probably wish other CEOs could have done the same thing. For a while, Cook's email was enough to haul back the entire sector from deep losses, but in the end, companies like Microsoft, Google, Facebook, and Netflix all sunk. That was it. That was IT.
And that was it for now. Thank you for watching, and we'll see you next week.